Good afternoon and welcome to our Market Pulse webinar, where we will be talking you through the consumer credit trends for Q1 2023. My name is Becky Oakes. I'm the Vice President of Analytics here at Equifax, and I'm delighted to say I'm joined by Kathy Katsouleris, our VP of Consulting, and Swarnima Pandey, our Head of Analytics Insights. So before we get started, I'd like to hand over to Jordan, who's going to talk you through how the On24 platform works. Jordan.
Thank you, Becky, and good afternoon, everyone. Thanks so much for joining us today. Each area within the On24 webinar platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There is an Ask a Question widget underneath each slide area, so feel free to enter any questions you may have and we'll address them throughout the session today. In the event there are too many questions to get through, we will generate an FAQ document which we'll send out to you in the coming weeks. Today's presentation in English and French is available to download in the related content area. This session is being recorded and you will receive the on-demand link via email tomorrow. Some additional features you'll notice on the bottom of your screen are attendee chat, reactions, register now for the upcoming commercial business trends webinar on June 8th, our survey, which will pop up at the end of the webinar, and contact us. Feel free to check any of these out and provide your feedback. We'd love to hear from you. That is all for me. Becky, back to you.
Thank you so much, Jordan. Okay, so let's get started talking through some of the important economic movements we've seen in the last quarter. There's probably no great surprise that these are really causing continued challenges in the credit space right now. So if we look at the inflation side of these, the most recent numbers for April were a 4.4% increase year on year, and that was slightly up from March, which of course is really the wrong direction for what we were hoping to see. Now, there really are a few things going on underneath that. Mortgage cost is now one of the biggest contributors towards inflation. And if we were to take that out, we actually see the inflation level dropping to around 3.7% rather than that 4.4%. Now, the unfortunate thing still is even if we take that mortgage inflation out, it's still gone up in April compared to March. If we do look at the rolling 3-month change in inflation, though, rather than a year-on-year view, and we go back to the start of the year, we actually were running at around 2%. So that was the good news, but unfortunately, we're seeing that increase again in April. Kind of some of the reasons apart from mortgage that's causing that rise, food is still quite high when we look at what's happening year on year. Now we've put on the screen here food from restaurants, but actually when we look at just food from the grocery store as well, that is still unfortunately seeing close to double digits in terms of inflation movement. So consumers are still finding increasing pressure as those essentials are getting more and more expensive. Now, when we get into the credit industry numbers in a bit, we'll show you that we aren't yet seeing any really significant leading indicators of a pullback in spend. So things like credit card balances are still rising. So that really is going to be a bit of an interesting talking point as we go through this. Now, as well as elements like food, housing affordability isn't really improving for most consumers either. I know there have been some reports in the press recently about an improvement for some, but when we look at our numbers, we're not yet seeing that. So if we take a look at rent, for example, which are the dark bars on the chart, and look at April, you will see those prices are still increasing. They haven't yet stabilized. So consumers are still finding that quite difficult to manage in terms of affordability on rent. Now, having said that, it's not all doom and gloom. When we look at disposable income, that has risen for many, and we've actually seen some of the rise is really helping to stave off some of those challenges of the higher cost of living, combined with some of the interest rate rises. Now, consumers are managing to cope with the higher prices and are still spending, but we are seeing those savings rates, which peaked during COVID, they have come down, but they are stabilizing, again, higher than pre-pandemic. So there is some good news out there when we look at the economic side of things. The challenge, of course, is that this isn't really an even distribution when we look at savings rates. Lower income individuals, we're not really seeing still that they have actually improved that much, and really a lot of those savings that are still coming through, they tend to be more on the higher income side of the population. Now, one of the reasons we've had this income growth during this really unusual period is that both employment rates and job vacancies have been high, leading to increases in wages for some. Now, we're just starting to see that change a little bit, with job vacancies being down compared to the same period last year. So that's really a very, very high level in terms of what we're seeing on the economic side of things. So we're going to move more into what's happening on the credit industry. Now, we're really seeing a continuation of some of the key trends that were emerging towards the end of last year. So firstly, credit activity has risen, and we saw that in Q4 as well. And we're also seeing increases on many products in terms of balances. Now, the economic situation has been unsurprisingly hitting the housing and mortgage market quite substantially. So we're going to talk to you a bit more about some of the numbers that we're seeing on that one. And finally, we are seeing some of the financial stress we talked a bit about last quarter starting to grow and really move into different pockets of the population. And that's going to be a lot of what we talk about today in terms of where we're seeing that through, some of that continued risk through the rest of 2023. So if we look at the overall position of consumer debt, that did remain high at the end of Q1 at 2.37 trillion. Now, for those of you who are quite savvy with numbers, you'll notice that this has actually stayed pretty stable compared to the prior quarter. In actual fact, it's a 0.03% drop. And that's quite unusual. This isn't something we normally see. We've been seeing for at least the going back through time, the foreseeable memory that I have, that's increased much more than that quarter on quarter. And the reason that the reason we're seeing this kind of small drop is really from the mortgage side. That was growing and growing, but this quarter, that growth has been really very small, only a 0.04% increase. And typically, we normally see around a 0.6% growth rate at this time of year. Now, on the non-mortgage side, that has actually dropped about 0.25%. However, that drops much, much smaller than we typically would expect. So normally in Q1, we see a lot of pullback on balances, things like credit cards, post the holiday season, a lot of balances get paid down. And in fact, we're seeing the opposite. We're seeing credit card balances rise in the first quarter. So it is a bit of a drop on the non-mortgage debt side when we look at balance, but actually we would expect it normally to be much, much more of a drop. Now, one of the reasons we're seeing credit card balances continue to rise is the continual growth in the credit active population here in Canada. So there were more than 1 million extra consumers that were credit active in Q1 compared to the prior year. And that's really coming from two areas. Firstly, we have population growth, and that's driven primarily from the high volumes of immigrants that Canada's looking to welcome currently. But it's also coming from increased credit use from existing residents of Canada. So there were consumers that were already here. They are starting to use that credit more and more. Now, if we dig a bit deeper on this and focus on just that new to credit population, that's both new to Canada and just individuals who are using credit for the first time, we can see large increases year on year on demand for products like cards, telco, and auto loans. So if you look on that chart on the left-hand side, you'll see that credit cards are seeing a 13% increase in terms of inquiries, for example. And actually 1 in 7 of those applying for credit in Q1 were new to credit. And that is a big increase compared to a year ago where it was 1 in 10. So this does create a more challenging landscape for lenders when they're decisioning applicants, particularly for this population, because there is limited or really no traditional credit information that's available at the point at which they first apply. Now, this population does remain a key priority for us here at Equifax because we're continually looking for ways to help this group via alternative data and even looking at things like the international credit reports that are available. So in addition to that new to credit population, when we look back 3 years ago, we see around 34% of the increase that was happening then in the credit active population now, sorry, the 34% now versus 6% back 3 years ago. We're seeing this increase really happen from the existing residents of Canada as well as kind of new to credit. So when we look at the 1 million extra consumers that became credit active in Q1, around 66% of those were already here in Canada. So it's not necessarily just that new to credit population that's causing this increase in credit activity. Now that's around 660,000 extra people. And when we look back to 2020, that was around 450,000. So again, a good increase that we're seeing there. Now this increased credit activity isn't necessarily a bad thing, but it can be an early warning sign of increased reliance on credit, potentially from things like the higher cost of living that we've had over the recent months. So what does all of this mean for credit usage? Well, if we look at the non-mortgage debt side of things in particular, at the end of Q1, balances were around 4.4% higher than 12 months ago. So that's an increase of just over $25 billion. Now, more than half of this increase, which you can see on that pie chart in the blue, that was actually due to the change in credit card balances. I'm going to deep dive into that a little bit later on with Swanema as to where that's coming from and why. We've also seen increases in particular on both the unsecured and secured lines of credit. Now, if we look at this at a consumer level and where that growth is coming from, we are seeing the average non-mortgage debt rise for most of the younger consumers and millennials. Now, these consumers do tend to be a bit more credit active. When you kind of hit the age range of 30 to 50-year-olds, that's where we see typically the most credit activity when we look at consumers from an age standpoint. And right now, that's where those millennials are sitting. So it's probably no surprise that their average debt levels are quite high anyway, because again, that's the most credit active period of your life generally. But we're seeing that the growth in that average debt level really pick up not only in that group, but also in the under 26-year-olds. So the under 26-year-olds, we saw average debt rise by about 29%. And when we look at the 26 to 45-year-olds, that's around 13% year on year. Now, in contrast to that, when we look at older consumers, they've actually shown a drop in average non-mortgage debt compared to last year. So there's definitely a kind of divergence going on when we look at credit usage between those two groups. So when we look at the interest rate rises we've had over the past 15 months, they're not only impacting consumers with existing variable rate products, they also impact new products that consumers are looking to open. So when we look outside of mortgages, we tend to see auto loans, installment loans, home equity lines of credit. That's where we are likely to get the biggest immediate impact of an interest rate change. So the chart on the slide, this is breaking down how much the minimum monthly payments amounts are for some of those products and how they've changed from Q1 2020, so pre-pandemic, through to the first quarter of this year, and also looking at how this differs for consumers with and without a mortgage. So if you look at the first couple of bars, these are auto loans, and they've really had a bit of a double whammy in terms of monthly payments. So during the COVID months, we had supply chain challenges on the auto side. We saw vehicle prices, particularly used vehicle prices, really increasing, and they've been unusually high, and they are still high right now. And this means that those loan amounts to purchase a vehicle are also been much higher than they were. When you combine that with increased financing costs, that equates to kind of $100, $120 per month on average for new auto loans that a consumer needs to pay when they're purchasing that new vehicle. Similarly, when we look at installment loans, we've seen average payments increase by over $100 per month for non-mortgage consumers, and actually a huge $220 for mortgage consumers. And those installment loans might be being used for multiple purposes. So there's a lot of movement in terms of affordability for consumers right now. We're seeing monthly payments increasing. So as consumers are taking out new credit, and we're seeing that credit demand increase, it is more costly for them to do so. So let's move on into what we're seeing in terms of financial stress across Canada right now. And there's some good news and there's some less good news when we look at this one. The good news is that when we look at the 30-plus balance delinquency rate by product, so what I mean by that is this is where a consumer has missed at least one payment on each of these products, and we're looking at the percentage of balance divided by total balance where that's occurring. The good news is that they are still below pre-pandemic levels. So you'll see on the chart there, those negative bars dropping below the line. The less good news, though, is that we are seeing large increases year on year. So the extent to which consumers are missing payments is on the rise. If any of you saw our press release today that went out to the media, you'll see we actually quoted an additional 175,000 more people missed at least one payment on their non-mortgage trades in Q1 than 12 months ago. So that's a pretty hefty number in terms of new consumers that are starting to miss payments. Now, in terms of where this growth in delinquency is coming from, you might remember from our last webinar that in the fourth quarter, we talked about this mainly coming from consumers who didn't have a mortgage. it was really the younger, potentially lower income consumers, maybe who have lower savings and perhaps weren't able to adapt as well to some of those higher costs of living with the inflation being where it was. But it's those groups where we saw those missed payments were on the rise in that period. Now, in Q1 this year, we are still seeing those consumers continue to miss payments, and there is still some growth in that non-mortgage population. But interestingly, we're seeing this start to shift a little bit. We're seeing a change in delinquency for the mortgage population as well. So consumers that have a mortgage, their missed payment levels, they're growing almost as fast as they are for those without a mortgage. Now, some of this is being driven by increased monthly payments as consumers renew their mortgages. Some of it is also linked to variable rate consumers in terms of, they're starting to kind of see increased payments as well. But it's really those payment shocks that is leading to an inability to stay up to date on all their debt commitments. In the first place, a consumer potentially looks to stop making payments if they have to. It's not on their mortgage, it's on non-mortgage debt. And that's where we're seeing some of that increase come through. We're also seeing an upward trend when we look at insolvencies as well. So bankruptcies, which is the blue line on the chart on the left-hand side, they dropped significantly post-COVID or during COVID, sorry, and they've stayed flat. We haven't really seen much of an uptick yet on the bankruptcy side, but consumer proposals have been on a steady rise for several quarters, and there's really no signs of that stopping just yet. In fact, when we look at many provinces like Ontario and BC and Alberta, that consumer proposal rate has actually started to exceed the levels that we had pre-pandemic. Now, another trend we're seeing on the insolvency side is also an increase in what we call surprise insolvencies. Now, when we look at the percentage of consumers filing for insolvency, this is where there isn't a delinquency that is evident on the credit file prior to that happening. And what we're starting to see is an increase in that, especially for consumers with a mortgage. And that's the orange line on the left-hand side. You'll see that uptick. And this is a really important trend for those of you who are out there making credit decisions, as we need to remember that a missed payment isn't necessarily the only indication that a consumer might be financially stressed. It's a very good indicator, but as we've seen on this mortgage insolvency levels, we're seeing more and more consumers coming insolvent with no real prior warning from the delinquency side. So the final thing on insolvencies, which is worth noting, is a bit like delinquencies. We are seeing an uptick for consumers with a mortgage during Q1 filing for consumer proposals. So on the chart on the left, you can see the increase coming through on that orange line, which represents mortgage holders. And actually, they are seeing a huge 37.5% increase year on year in terms of consumer proposal or change in consumer proposals. So definitely a trend to keep an eye on. So if we have things like surprise insolvencies coming through and potentially some stress on consumers who typically would normally be seen as lower risk, so the mortgage population, they normally have much higher credit scores, things like that, what can you look at to help identify pockets of stress that might be occurring? Well, there's a few examples we've put on the screen where we've done some analysis to look at non-mortgage consumers and tracking what happened to missed payments over a 3-month period. And so this population that we looked at, they were not delinquent to start with, they were up to date on all their credit commitments, and just looked at some of the behavioral changes of how they use credit and seen, is that a good early indicator of financial stress? So to start with, we looked at switching from a transactor payment behavior on a credit card to a revolver behavior. So this is someone that was paying in full on their credit card, switching to a lower payment rate. And that actually is a good early indicator. We see up to 2.5 times the likelihood to miss a payment in the next 3 months once that's happened. Where minimum payments are increasing, so if you look at a consumer's commitments they have to make on a monthly basis, and we see an increase there of over $250 per month, 3 times more likely to miss payment than those that haven't had any increase. And when you look at something like changes in capacity, and this is actually using the Equifax capacity indicator, which tries to estimate how much a consumer could take on additionally and still be able to make all of their commitments. Where we see that level coming down, so where we start to see that reducing, there is a 30% increase in likelihood to miss a payment. So there are a few examples of what you can look at as well as delinquency to help to kind of really get some early indications of some potential financial stress that might be coming through. Okay, I'm going to take a pause before we dig into some of the product-specific trends with Swanima and see if there's any questions. Swanima, are there any questions? Okay.
Yes. Given the high debt levels complemented with higher inflation, do you think consumers can service their debt in the short term?
Yeah, it's a great question. And I think, when we, again, going back to the trend we saw in Q4, where we saw consumers start to miss more and more payments, that likely is a combination of those things, which is underlying some of those challenges. And I think that's why we saw that particularly happen on some of the lower income populations in particular. When you look at something like the savings levels, which is actually really important, and we've seen this a lot in the UK as well, where they actually have savings data that they can access. More and more, they have seen consumers dipping into savings to actually keep making on their credit commitments. And so what that means is if you have a buffer and you manage to accumulate savings during the COVID months, or maybe just day to day, you're able to do that, you actually have more ability to handle increases in inflation and things like that. If you're on the other side there, where you don't have savings, potentially there are limited options for consumers to reduce their outgoings. There's always some good advice, that I've seen out in the press where changing your where you shop. Maybe you go to one supermarket and you change to another, and it's lower prices. That can be a good way to reduce some of your outgoings. But if you're a consumer where you are already going to some of the more cheaper stores to kind of buy your goods, maybe you actually are very actively managing your budget very tightly, where you get sudden increases in things like food, it's very difficult to be able to absorb that, particularly if you have no savings to kind of call on. So.
Okay, there's another question about insolvencies. Do you have any insight as to why there is a disconnection between consumer proposal trend and bankruptcy trend?
That's a great question. I think when you think about some of the higher balance products that are likely to be impacted during this current period, where you have things like home equity lines of credit, or auto loans tend to be a bit higher value loans, or mortgages, they are consumers who potentially have some assets. And therefore, the consumer proposal, if they can keep making the repayments on the assets, like a mortgage or an auto loan, the consumer proposal does offer a way to reduce some of the other debt they might have, but allowing them to not lose their assets. So I think that might be part of the reason. I don't know, Swanima, you yourself, and you spend a lot of time looking at insolvencies. Is there anything else you would add to that?
No, for consumer proposals, it is a slightly better way of getting rid of some of your debt, because you don't lose your house, you don't lose your car, and a lot of secured lending is saved. So I think that's why a lot of people are moving towards consumer proposals, especially consumers with a mortgage who don't want to lose their house, and they don't want to start missing on their credit payments as well. So that's why we also see a higher percentage of consumers with a mortgage going for consumer proposals rather than missing payments.
Yeah, I think as well, they're also just advertised a lot more. If you go back 3, 4, 5 years, were the general population as aware of consumer proposals as perhaps they are now? Not trying to say what my social media habits, but if I go on Facebook sometimes, you see them advertised. You kind of see them everywhere in terms of want to reduce your debt. So I think it's partly that, in terms of there is a population, and we saw on the mortgage population on a slide a bit ago where that is starting to uptick. And again, that's probably, there's consumers who have their own home, they have a mortgage, and they are starting to struggle with their finances, and they want to protect their home. I think there's definitely some of it, but I think it's just more that people are more aware that it's an option, and actually it gives them a middle ground almost. It's not a full bankruptcy.
Do you want to take one more question before we move to the next slides?
Yeah, sure.
Okay. Could you explain what you mean by switching from transactor to revolver?
Yeah, so a transactor is really someone who's actively using their credit card. So they're spending on their credit card each month. And by the end of the cycle, they are paying that off in full. So they pretty much are just, I'll go to the grocery store, spend $200, and then I pay that off as soon as I get my bill through. So that's what we call a transactor. They're not revolving a balance. A revolver is really where they aren't paying that balance in full. And that has a range to it. So it can go from anything from a minimum payer, which would be typically something like 3% of the balance, all the way through to kind of 95% of the balance. That tends to be where we kind of make the cutoff between those, the distinction between the two. And I think Swanam was going to talk to you in a little bit about what's happening with some of the pay rates on that revolver population, because that's quite interesting in terms of some of the trends we're seeing there. Okay. All right. So Swanam, do you maybe want to talk us through what's happening on the credit card side of things?
Yes, sure. Thanks, Becky. Let's start with credit card, a credit product which has seen the biggest growth this quarter. Credit card growth has been really strong since 2022. Normally, coming out of the holiday seasons, we expect seasonal drop in credit card debt as consumers start to pay down their December spending, but not this quarter. Overall, credit card debt continued the upward trend from the last quarter to this quarter and is now at a record high of $102 billion. It's up 14.5% from what it was 1 year ago. And from the last quarter, it's up by 1.7%. Now, credit card spending has also been at an all-time high, but the average monthly spend per credit card consumer is at $2,200 for this quarter. It's 12% up from Q1 last year, but it has shown a seasonal drop from the last quarter. So spending had a seasonal drop, but the balance continued to increase. In the next couple of slides, we'll deep dive into what is driving credit card balance and what is the composition of this credit card balance. So first, let's look at how much of this growth is coming from new to credit consumers, new to Canada, and how much of it is coming from the existing consumers. As Becky mentioned earlier, newly credit active consumers have been increasing, and that has in turn pushed credit card balance up. The red line shows the credit card balance coming from new to credit consumers. So anyone who opened a credit file in the last 12 months, that's the balance growth that they're showing. And you can see how much more the segment has grown in the last 1 year. Like balances from the segment is 52% higher when you compare it with from 2022. But the balance is not just being driven by new consumers. Existing consumers are also leaning towards credit cards. Credit card debt levels for this group is going up by 14.3% and now sits at $101 billion, surpassing pre-pandemic levels. So higher cost of living, more credit card usage, as well as new card growth are all contributing to the overall credit card balance. Now, one of the major drivers of credit card debt is the growth in new cards. We touched on this in the last quarter as well. Close to 1.45 million new cards were issued just this quarter. And if you just look at last 12 months, it's 5.7 million new cards were added to the credit card portfolio. So new to credit consumers tend to be a big part of new card growth. Like 25% of new card growth is coming from new to credit consumers. So younger consumers just entering the credit space or people who are new to the country. On average, a new to Canada consumer gets a credit card in the first 6 months of opening a credit file, and it's usually the first product in their wallet. So this segment does drive a lot of new credit card growth. But we are also seeing high credit participation from existing consumers, where demand for unsecured lending is increasing as more consumers are taking new credit cards. Now, new growth was also fueled by high credit limits. Lenders have shown aggressive acquisition strategy with credit limit on new cards now over $5,800. It is almost $1,000 more than what you would expect pre-pandemic. But despite higher credit limits and huge new originations, banks have started to tighten borrowing criteria. Like percentage of new credit card originating from low score groups, that is under 620 score, is declining. Even the credit limit assignment for this group has seen a small quarter-over-quarter drop from the last quarter. But For high score consumers, average credit limit continues to rise, and it's over $9,500 as of this quarter. As debt levels are increasing, so is the financial stress. Now, as Becky explained, the largest increase in non-mortgage balance is coming from credit cards. So $12 billion were added in credit card debt in the last 12 months. We can split this balance growth in three parts. First, as we saw earlier, balance driven by new to credit consumers. So anyone with a credit file of less than 12 months this quarter, their balance went up by $200 million when compared to this group 1 year ago. The second group is the transactors, so consumers who are paying their credit card balance in full. So 44% of credit card balance growth is coming from consumer segments who are more likely to pay off their debt fully in the next payment cycle. The third and the major chunk of balance growth is coming from revolvers. So consumers who are paying less than 90% of their credit card debt. And the balance from this section went up by $7 billion from Q1 2022. And this makes up for 54% of overall balance increase. So the biggest increase is coming from revolvers, and this will eventually lead to increasing risk of missed payments. The third component to credit card growth is credit card spend. Consumers' spending on credit cards has also reached record highs. Last holiday season, average spend was close to $2,600. It shows a seasonal drop this quarter, but remained higher than previous years. As you can see in this chart, we have been showing this chart for the last couple of webinars, and it clearly shows the shift in average credit card spending over the last few years. Now, higher spend was not an issue in 2021, as consumers were also paying more on their credit cards, and revolving rates were low, but now pay rates are slowing down. So average balance per revolver continues to go up because their pay rates are declining. So for every dollar spent, revolvers are paying 93 cents. We're paying 93 cents as of Q1 2022, and it's down again this quarter to 90 cents. So lower pay rates have triggered rise in delinquency rates as well. Despite high balance and spend, credit card delinquencies have remained below 2019 levels, though delinquency rates are rising slowly. Some of the increases in delinquency is being masked by new credit growth. So that's why we are not seeing this big rise in credit card delinquency yet. It is masked by the overall growth in number of accounts and overall credit card balances. But when we look at the delinquency vintages, we can see that the newly opened trades have started to miss payments after 12 months of opening and have a much higher arrears rate than accounts opened in 2019. So this chart shows all credit cards opened by open date, and we have separated them by different score groups at the origination time, and we're looking at their 90+ delinquency rates after 12 months. So we do see that the major increase in delinquency is coming from consumers where credit score was under 660 at the time they got their credit card. Now, the drop in this chart is for the accounts opened in 2020, where consumers could pay off their debt, because we're looking at 12 months after 2020, that is 2021, which was during the pandemic. And we have not shown that in this chart, but when we looked at this segment after 24 months, their delinquency rates have jumped back again. So consumers who benefited from government benefits and deferral programs have also started to miss payments again in 2022 as the savings from pandemic is depleting. So economically vulnerable consumer segments have started to feel financial pressure, and deteriorating credit card payment behavior is usually the first signs of financial stress. Now I'll hand it over to Kathy to explain if we are seeing what we are seeing, the trends that we are seeing aligns with the global trends.
Great. Thanks, Ranima, for that deep dive on the cards industry. Lots of great insights there. So just to help recap what we just heard, first of all, we're seeing a significant increase when it comes to new cards being issued with higher credit limits. Next thing we saw was the delinquency rates may not look like they're increasing back up to pre-pandemic levels, but that's really because they're being masked by that increasing growth number in the denominator. Also, when we looked at that vintage view of arrears, especially the more recent one, it's pretty evident that there are pockets of stress coming through. And lastly, we anticipate that the consumers will have lower pay rates. The ones that do have lower pay rates will actually start to roll into missed payments. Now, what we wanted to do this time was really take a look to understand what's happening from a global credit perspective. And so we see in places like Australia and the UK, credit card debt has actually slowed down because the market shift there to buy now, pay later. From a utilization perspective, this indicator appears to be up across all regions, signaling that consumers are leveraging their credit to get by, given that in 2022, inflation rates really rose across the world, not just here in Canada. Last important item to note is that in the US, the credit card delinquency rates are actually back up to pre-pandemic levels. So let's unpack these insights. So for the lenders that are in this space, what does this mean and what should you be thinking about? So for starters, as we saw, newer card vintages with lower scores need to be monitored more closely, given the increasing trend of higher delinquency rates for this credit segment. This is the pocket that is clearly sensitive to stress. In addition, another behavior that you'll need to monitor more closely is the impact of the higher interest rate costs when it comes to unsecured lending and how it may change the consumer's financial position because it's going to impact their cash flow and pay rates. And lastly, as buy now, pay later picks up speed here in Canada and popularity, it might be that option that Canadians look to take more advantage of when it comes to financing their retail purchases. So on that note, I'm going to pass it back to Swarnima, who's going to help us gear up and see what's been happening in the auto industry.
Thanks, Kathy. Auto is another credit space where we have seen a lot of changes in the last 1 year. Like auto supply chain issues are easing now. Wait time for vehicles is getting better than what it was during the pandemic. And we are seeing more new auto originations. While auto loans are improving, demand for auto leases is continuously going down. Let's first look at new originations for non-bank and captive auto lenders. Auto loans are up across all consumer segments. Younger consumers usually drive new auto originations. And even for this quarter, we have seen that consumers between age 26 to 35 have seen the biggest increase compared to the last year and to the pandemic. We're also seeing uptake in the new originations coming from seniors, but it's also because this segment saw the biggest drop in demand in the past 1 year. So hence that increase is much bigger when compared to that. While there's a lot of pent-up demand for auto prices remained high, despite supply chain issues easing a little, causing affordability issues for many, especially with higher borrowing costs. Average credit limit on new auto loans is at 28.7K, and it's up by 10.8% year over year, which is a big increase. And we have seen loan amounts increase for auto lending. And this trend is very similar across all provinces. However, when we look at auto leases, that's where we see the biggest drop in new originations. The chart shows auto leases, the share of auto leases for both portfolio balance growth as well as new originations. So lower new originations have pushed the market share of leases back to 2015 level. And ironically, one of the main reasons for low leasing activity is the same reason why so many people preferred it in the first place. And that was because of the new vehicle affordability or the lack of it. Consumers could afford a new vehicle at a lower monthly payment, but with vehicle prices so high and vehicle availability so low, leasing is no longer offering an advantage over financing for many consumers. And that's why we are seeing such low volumes for leases. And even average lease amount for new origination is at a record high as of this quarter. It's over $33,000, making leasing not the best financial choice for many consumers out there. Moving on to bank loans. A major shift in the market that we have seen is for the used cars. While both new and used cars were impacted, their car prices have skyrocketed. The biggest increase was still found in used cars due to low or no availability of new cars during the pandemic periods. Average loan amount for new cars went up by 12%, But if you look at used car, the average loan amounts went up by 31% when compared to the pre-pandemic time. We have seen some of the largest increases in used car auto loan over the last few years, and higher loans have pushed amortization term for used cars over 72 months, which was not the case pre-pandemic. While vehicle prices are expected to go down, but cost of borrowing remained high with high interest rate. Like average interest rate is going up to 10% for used car, and it's around 7% for new cars. And in the last 12 months, we have seen some of the biggest auto loans being taken out with higher monthly payment and higher amortization term. Now that is impacting consumer payment behavior for auto. Auto loan is the only credit product where we are seeing higher than pre-pandemic delinquency for account level 90+ delinquency rates. Now, higher loan amounts, again, are masking some of the balance level delinquency. That's why you don't see the same rise in the blue line, which is the balance delinquency, versus the gray line, which is the account level delinquency. And arrears in auto are more pronounced in certain regions than others. So the map on the right side shows change in 90+ account level delinquency rates across all postal codes. The red indicates the biggest jump in delinquencies, while green indicates lower than pandemic levels. So for example, if you look at Vancouver, it has seen the biggest jump in auto delinquencies when compared to Q1 2020. Now, higher cost of living could be impacting consumer payments in Vancouver. We are even seeing increasing auto delinquencies for auto and parts of GTA, where people have started to missing more payments on auto than they were pre-pandemic. Again, for auto, we looked at vintages to see where these delinquencies are originating. And we see that it's the newer accounts opened in post-2022, who have seen the maximum increase in delinquencies after 12 months of opening. Now, this is a chart that shows 60+ account level delinquency rates across different score groups for both US and Canada. The line represents percentage of auto loans which have missed payments for 60 or more days after 12 months of opening. The solid line is Canada, and the dotted ones are US. So both countries are following the same trend, but towards the end, we clearly see a divergence that shows much higher delinquency levels in the US for auto loans than in Canada. And this could be a very good early indicator of what we can expect for the auto delinquencies in the Canadian market. We enter auto following similar. Now, Kathy will go over in detail what this means for the lenders.
Thanks, Purnima. So just really before I do that, I'm just going to help summarize just some of the key highlights on what we just heard. So first off, year over year, auto loans are up, but in comparison to pre-pandemic levels, they're still down. For more recent origination vintages, we're seeing that more subprime and near prime consumers are starting to miss payments. And when we compare this to pre-pandemic levels, it's actually a lot higher. We heard when it comes to leasing, we continue to see that downward trend where consumers are buying more instead of leasing. From a positive perspective, the supply chain issues that really crippled the auto industry during the pandemic, we're seeing improvement there. For prices for both the new and used vehicles, unfortunately, they'll continue to be higher than pre-pandemic. As we just saw, when we look at what's been happening in the US, we see that the missed payments on 2022 new loan vintages were much higher than those in comparison to Canada. However, what's common in both countries is that, again, newer vintages are showing earlier signs of stress when it comes to missed payments. So speaking about stress, let's segue back to sort of, if you are a lender in this space, what should you be thinking about? So we've got these pockets of consumers who clearly bought a car during the pandemic with the inflated prices. It's going to be very important to continue to monitor them, given that as the asset depreciates in value, their loan may be higher in value. And if they experience any type of financial stress, well, I think defaulting on that loan is going to be very likely. As always, again, staying close to your risk policies and strategies and really evaluating and optimizing them to minimize risk exposure is a best practice. Same goes with the collection strategies. Review them and optimize them so that you're in a position to minimize your losses and maximize your recovery. And last thing I want to touch on is just from a growth perspective, if growth isn't where you'd like it to be, do a lost sales analysis, including some reject inferencing to understand, what changes you can make to improve it. Why are you losing deals? How can you make your offers more attractive? Are your credit policies too tight? Again, there's always an opportunity to improve things. Okay, so let's put this auto talk into park and head back to Swarnima to talk to us a little bit about mortgages.
Thanks, Kathy. So moving on to mortgages, the most talked about credit product in the last 1 year. Ever since interest rates started rising from the lows of 2020, mortgage originations have slowed down. Overall, mortgage balance growth was the slowest this year when compared to the first quarter of 2022. Average home prices went down. Both first-time home buyers and refinancing activity has seen some of the biggest drops. Now, mortgage new originations is down by 42% year over year. It's 100K less originations than Q1 2022. Levels have dropped even below pre-pandemic for Toronto and Vancouver. New mortgage originations is less than half of what we have seen 1 year ago. Low financing activity, lower intercity migration, and reduced first-time home buyers are contributing to slow mortgage growth. And mortgage market has also, slowdown in mortgage market has also helped house prices stabilize a bit. Average loan amount is lower than what it was 1 year ago, though the drop is not as significant as anticipated. The mortgage market still remained a seller's market for most regions. And however, the mortgage market might pick up next quarter. According to Canadian Real Estate Association's latest report, April home sales have been higher than March sales, indicating mortgage levels for next quarter could improve as consumers adopt to the changing market. For many consumers, this could be the right time to purchase homes since prices are slightly down. But some of the biggest drops in average loan amount was visible in some of the hottest markets. So the map shows provinces with biggest increases in average loan amount on mortgages, red indicating the biggest jump and green the least. And the underlying number shows the drop from the peak. And this drop is highest for regions with the highest growth in average loan amounts or home prices. So BC and Ontario have shown the biggest drop in price corrections. But this quarter could be the end of price correction as well, as the new report from Canadian Real Estate Association shows an increase in average home price index in April when compared to March. And it's jumped by 1.6%, which is a big jump in 1 month. Now, despite price corrections, affordability is still an issue for many, especially first-time home buyers. As you can see from the chart, the gray bars on the chart show the average loan amount of first-time home buyers, which have continuously increased. They have not seen a drop in the loan amounts of first-time home buyers. So that could be concerning. And the average payments have continuously gone up. And that is reducing the number of, the percentage of share of first-time home buyers in the market currently. But the current mortgage market is very economically challenging for many mortgage consumers. Delinquency rates have remained low for the longest time, but now pockets of financial stress is visible. As Becky mentioned previously, that consumers with a mortgage have started to miss payments on non-mortgage products. Some have even started to miss payments on their mortgages. Now we are seeing increase in early delinquency for regions with maximum growth in mortgage during the pandemic. Now, Vancouver, Toronto, and parts of GTA are showing increasing signs of delinquency. It's higher than the national average, even though their overall delinquency levels are lower than the overall average. But when you look at regions like Edmonton and Calgary, where delinquency rates have historically been higher, these regions have not shown the similar increase. In fact, they have shown a year-over-year drop in delinquencies when compared to Q1 2022. So early delinquencies are still quite volatile, but high inflation and rising cost of mortgage payment could result in early delinquencies rolling over to late delinquencies for consumers who are in extreme financial stress. We can assess financial stress levels of mortgage holders by splitting mortgage portfolio into 6 categories. So with 23% of mortgages having some change in the payment amount. So first group would be recently renewed mortgages, would be struggling to make payments with the current payment shocks. And then there are mortgages with variable rates where payments have already went up by 45 to 30%, and they must be feeling the financial stress of increased payments. Now, the other group is the group that could be affected in the next 12 months. So these are the group that could get a huge payment shock on upcoming renewals. And we are seeing financial stress from consumers coping with recent renewals. If you look at the next slide, which shows consumers who experienced a payment shock, especially those where the increase was around 40%, 42% in their payments, those consumers have missed payment on a non-mortgage product at a much higher rate than other mortgages. So we are expecting around 750,000 renewals in the next 12 months. So these upcoming renewals is very important, especially consumers who have still a huge chunk of their mortgage left to be repaid. So they could get a huge payment shock in the next 12 months. We have done a further segmentation of the entire credit active consumer population to identify pockets of stress, which Kathy will cover in the next sections.
All right, but before I do, let me just do a quick little recap on what we've just heard with regards to the mortgage industry. So, you know, the market has continued to cool where prices have fallen, but there's still signs that it's a seller's market because the housing demand is greater than the supply. For the first-time home buyers, again, affordability is still an impeding factor with those high interest rates. Plus, you know, there's some speculation that there's even more coming, right? We'll see what happens tomorrow. For consumers that have renewals coming up, you know, many are at high risk of a payment shock, which can impact their financial position. When we look elsewhere in the world, starting with the UK, we see that the fastest drop in house prices there since the 2008 financial crisis. And there, lenders are actually removing and updating mortgage offers with more macroeconomic stability. Down under in Australia, we're seeing newer mortgage vintages with missed payments, which is a clear sign of early stress. Again, similarly there, you know, it's estimated that consumers coming up for renewal are also in for significant payment shock, which brings us back again, you know, for lenders in this space, what should you be doing and what should you be thinking about? So when it comes to managing risk and renewals, segmenting your portfolio, and again, focusing on those upcoming renewals, understanding the financial position of the consumers, including total debt, cash flow, capacity. That's really the key to understanding who's at risk of a payment shock. For those that will be in this category, again, adjusting strategies to support the consumer and help them navigate through the stress, that's going to be key. In addition, retention here is going to be, it will mean, you know, putting that best offer forward to ensure, you know, attrition risk is reduced. From a growth perspective, again, softer market means less new mortgages are up for grabs, which means really 2 key things. First of all, optimize the channels that the shoppers are using to understand if they qualify for a mortgage with you. And second, you know, ensure that the offers are market competitive and attractive to buyer. On the flip side, you're going to need to refine your policies to ensure you're looking at all debt and payment levels over time, not just the latest snapshot. And if they do have the capacity to take on a new mortgage payment. Once on the books, again, closely monitoring the credit activity and the behavior changes. It's going to be critical to, especially in monitoring those early warning signs like the missed payments that we've been talking about in the last hour. So switching gears right now, as Swarnima mentioned, we did look at a segmentation of the Canadian population. And again, this allows us to see the pockets of consumers where stress is really coming through. So what we did here is, you know, we looked at the Canadian population and we first segmented them by looking at who has a mortgage and who doesn't. And so that we could then further identify which pockets are more at risk of experiencing that financial stress. So here we've got the non-mortgage consumers, which account for 69% or 21 million. And then double clicking on this specific population, we're able to further segment this population by looking at key attributes that would classify them into these distinct cohorts that you see here on the right side. So for example, the high bucket, it consists of about 1.3 million consumers that have already missed payments in the last 12 months. So they're already there. They're already experiencing financial stress. The medium high bucket, it accounts for close to 3 million consumers, and it consists of individuals that have reduced cash flow, high revolving debt, lower income levels, and really reduced payments, which it puts this cohort at an increased risk of moving towards that financial stress that needs to be monitored more closely. The other two cohorts make up 80% of this group, and they've got lower risk associated with them. And they're characterized by utilization levels, capacity, and higher credit scores and higher income. So let's do the same thing that we just did now, but with the consumers that actually have a mortgage. So here this population makes up 31% or 9.1 consumers. Similarly, again, if we double click on this population, we're able to further break it down into 3 distinct cohorts that showcase the different levels of risk based on some key characteristics. That high bucket, again, is defined by those that have missed payment in the last 12 months, so they're already risky. The next medium bucket are those that are up for renewal or they recently renewed and where there is a potential for a payment shock. This is a group that really needs to be monitored more closely. And finally, that last bucket makes up 70% of the mortgage holders. You know, they may not be facing a renewal, or if they are, there's very little to no impact in terms of risk. So essentially for both mortgage and non-mortgage holders, you know, when we drill down and we segment these groups, you know, you can identify the key pockets that are really at risk in terms of experiencing financial stress. So in summary, really from this segmentation analysis, we do see, you know, the good news is the majority of the population has low or medium low risk levels. And for you as lenders, you know, doing a similar analysis on your own portfolio is going to allow you to see which proportion and which segments in your book you really need to monitor more closely. I know we're running out of time. Becky, I'm going to hand it back to you to see if we've got any questions and for you to wrap up. Thank you.
Thank you, Kathy. We have lots and lots of questions, and in 2 minutes, we are definitely not going to get through all of those. So let me just pick off a few. So there's a question around how are higher loan balances masking delinquencies? Great question, particularly look at something like the mortgage portfolio where we've seen those balances get higher and higher. They do mask them to a degree. You tend to get a lag with the balance delinquency. We do also look at volume delinquency as well. So on mortgages, that is also seeing an uptick. On auto loans in particular, I believe, so I want to keep me honest here, when we look at volume delinquency, auto loans are definitely back to pre-pandemic levels now. So some of the other products are still increasing, but auto loans, I believe, is fully back when you look at volume and back out that balance piece. Do you think the mortgage rates increasing again tomorrow? Well, I guess interest rates. I mean, I think the view when I speak to some of our experienced economists here, they will say, if not this time, then probably in July, we expect another 0.25% increase. We think that is highly likely to happen. Anything else? Any you can see we can pick off quickly? For those that we don't get to, we absolutely will send out an FAQ document afterwards. There's a question around, can you give details about where the highest spend on credit card was directed? Is it staple items or discretionary spending? Unfortunately, we don't see the breakdown at the basket level on things like that. However, what we can tell you is I know particularly 2021 and into 2022, we saw increases with big ticket items, so probably things like vacations, we saw that increasing, but we also did see an increase on the lower end as well. And I'm going to pause there just so we can do a little bit of a wrap up in terms of other opportunities to gain some insights from us. On Thursday this week, we have Sinead and Jeff from our commercial teams presenting our business credit trends. They're going to be joined by Michael Roth from the Canadian Finance and Leasing Association. As always, this is a free event, definitely worth attending. They have lots and lots of great information. And if you aren't completely bored of hearing our voices, there is the annual CSRSA conference being held in Niagara starting Sunday 11th. So this Sunday through Tuesday, Myself and Kathy are going to be presenting on the consumer side with a bit more of a focus on some of the strategies and scoring implications of the trends we're seeing right now. Sinead will also be there from the business team. And we also have Carl Davis, who's our resident fraud expert, speaking on the fraud panel there. And there's also some amazing speakers like Osfi going to be at that CSRSA conference. So I believe the early bird tickets for that have now sold out. But if you are still interested, if you want to drop myself or Kathy a message, we can help secure you a discount on tickets. Apart from that, thank you so much for attending today. I know we had a lot of content to get through. We will follow up with an FAQ document, and please do complete the survey. We love to get feedback from you all, and we'll see you next time.